Okay, Ms. Baker, all set.
Okay, you let me know when we're ready, Mike.
We're ready. Go ahead and get started. Ms. Roberts, I'm not sure if you're gonna go first, but we are ready to get
Yes,
started.
she will.
Okay.
Okay. All right, I can go ahead and get started. Good morning, everyone. Good morning. My name is Tamara Roberts, and I'm the Assistant Chief Procurement Officer in the Office of Procurement and Materials. It's a pleasure to be here today representing our procurement office, along with our Vice President and Chief Procurement Officer, Fifi Magosi, and our General Manager, Randy Clark. First, I want to extend a warm welcome to you all, and thank you for joining us at this important financial session for our small businesses. Our procurement office is dedicated to fostering relationships with the vibrant small business community. We believe that small businesses are the backbone of our community, bringing innovation, agility, and a personal touch to everything we do, or everything that you all do. It's our mission to support and engage with you, helping to create opportunities that allow your businesses to thrive. Today's event is not only about securing your financial future, but also networking and exchanging ideas. It's about building a strong partnership. We want to understand your needs, address your challenges, and find ways to work together that benefit both your businesses and our organization. I'm also honored to introduce a key partner in our efforts to support small businesses, the Director of our Small Business Programs Office, Michelle Howard. Michelle and her team have been instrumental in developing and implementing initiatives that specifically address the needs of small businesses like yours. Michelle will be coming up next to provide commentary on our event for today. So on behalf of the Chief Procurement Officer and our entire team, I want to emphasize our commitment to transparency, fairness, and collaboration. We are here to listen, to learn, and to work with you to streamline processes and make it easier for small businesses to participate in procurement opportunities. Thank you again for being here and your ongoing contributions to our community. Let's make the most of this opportunity to connect, share insights, and pave the way for future collaborations. And now to the person who makes this all happen, Michelle Howard, the Director of the Small Business Programs Office. Michelle?
Thank you so much, Tammy. Thank you. I really appreciate when you're here supporting us. You know, we love you, and it just makes it feel good.
Of course, we are all team. Thank you, Michelle.
Thank you so much. Again, good morning, everyone. And thank you for participating today in WMATA's Small Business Programs Outreach. Today, we have for you Asset Avenues in collaboration with World Financial Group, who you will hear from Ms. Pauline and Philip. At WMATA, believe that we are about our certification, our certified businesses. So certification is the key to participation. And we encourage all of those who are not participated to get certified with WMATA. So please spread the word to those who you know that are not certified to get certified with us. We have 5 social economic programs that you can be certified in. Most of you may already know we have our disadvantage and small business programs, which is on the federal side, but we also have our new non-federal local programs, which is minority business, small business, and micro business. So please check those out on our website and learn more about those programs so that you can be certified in those additional procuring opportunities. We are definitely open for business, and we want you to be a part of that contracting opportunities here at WMATA. We are your metro, the way forward. Please make sure you put all questions in the chat and remember to fill out the surveys that will be sent to you after the outreach event. Because these surveys, they help us to plan events that can benefit or support the growth of your business. So they're very important to give that type of feedback to us And we will make sure we read them and start to have those things that help to benefit your business as far as educating you on different subject matter. So our presenters today, I said we have Philip and we have Parlene. Philip is a financial advisor and educator and devoted to empowering individuals, families, and businesses in reaching their financial objectives and establishing a secure financial footing for the future. He fosters collaborative relationships with clients to address financial challenges proactively. With extensive experience, he serves as a trusted personal finance specialist offering tailored services focused on tax optimized financial decisions. Philip has guided numerous clients through pivotal financial milestones from retirement planning to college funding using strategic insights and personalized strategies to ensure financial security. Now, we're going to talk about Miss Pauline. Miss Pauline has been a financial literacy advocate for over 27 years and officially became a financial advisor a little over a year ago. Her previous career was 25 plus years of experience in the transportation industry and in strategic planning and change management. So I want to bring on for you, Philip and Pauline, and I want to thank them for the session today as well.
Thank you very much, Ms. Michelle. Good to see you again. Ms. Pauline, are you on?
It's great to see you guys. Welcome back. Welcome back.
Thank you.
Thank you for having us. Yes. Okay. So good morning, everybody. I hope everybody is having a good day. Bear with me as I go through this. The allergy season have kicked in, so please bear with me as we go through. Right? Good morning, everyone. Again, my name is Pauline Tiako, and today we're going to be looking at asset avenues and figuring out ways of navigating wealth growth through strategic accumulation tactics. Right? And this is brought to you through our educational piece, which is the World System Builder Financial Education Workshop. So first off, we're going to start off with the disclaimer. The information in this presentation should not be interpreted as accounting, investment, legal, or tax advice. It's not an offer to sell or a solicitation to buy any security, insurance, or any other financial product. This workshop is for educational purposes only. Our national campaign for financial literacy is to bring financial awareness and education. You will not learn everything during the course of this workshop. However, we hope you learn, gain more confidence, and take action towards reaching your goals. Being part of our campaign, we encourage you to help empower others to do the same. To help us preserve the integrity and the content of the information, please do not take any photos, videos, or record this workshop. We do have exceptions to the rule for that because this is something that is important. So this session will be recorded today. So once again, welcome to our workshop, And what happens is that every day we have people who get, flooded left, right, and center with information. And what happens is that most of the people who offer financial advice are not licensed and they don't have industry experience, right? And those in the traditional industry narrowly focus on one or two aspects of your finances, right? We here at World System Builder, which is our education team, we are here to help you look at a total picture, a holistic approach. So we start off from the individual going out to the family into the business. So when we talk about what it is that we do, we're looking to educate and empower you to become your own money manager and to be able to learn how to run your business more efficiently. Because when you start from the individual, then everything else comes and falls into place. We will educate you in a way that we hope you will understand that once you control your finances, you will be able to control your future. So today's workshop, we are going to learn about accumulating wealth and the cost of waiting, looking at historical returns, average returns, and your returns, and last but not least, strategies and minimizing risks. When we look at it, what part and what level are you in your investment intelligence? Can you think about the first time you ever encountered anything that is investment related? Was it a retirement plan at your first job where you walked into the HR office and they gave you paperwork and told you sign here, you get a 401k or 403b or 457b or a TPS? Or is it a gift you got from or you were taught by your parents? Or is it at the point where you got to that age and you were like, oh my God, I have nothing. I need to start something right now. So one of the questions we always ask people is, where do you get your investment advice from, right? How do you know what you're being told to do and if that's the right thing to do and what to do with it, right? Many people are eager to jump into investing, but however, we have to be very careful and make sure that we are building the knowledge first so that way we can get a strong foundation. Because as we all know, without a strong foundation, everything collapses, right? So when it comes to the financial foundation, just like building a house, you must start from building from ground up, right? We have proper protection. Basically, what this means is you got to make sure that you're fully covered because you are the golden goose that lays the egg. Without you, nothing happens. So you have to make sure that you focus on making sure that not only do you have health insurance, you also have life insurance, you also have insurance for your business as well. You have disability insurance, as well as long-term care, as well as looking at it from the perspective of if something was to happen to you, what contingencies do you have in place to make sure that things still continue moving? Because your business is always going to be there. And there are bills that come with it. And then also at your home, there are also bills that are waiting to be processed. So you got to make sure that you have a contingency plan if something was to happen to you. Right. The next one is debt management. This is to ensure and to make sure that everybody is able to manage their debt and get to a point whereby it is something that is not overwhelming and it is something that, takes over, especially your business and your personal life. Right. And then, of course, getting an emergency fund. Everybody remembers COVID where everything was shut down. That's when people came to a realization that it is imperative to have money set aside to make sure, like now, for example, payroll is going to be met. You don't want to be relying on a credit card to pay payroll. So it's imperative that you start those good habits of making sure you have that emergency fund ready and set aside. Right. And last but not least is investment. Understanding where you invest your money, where your money works for you instead of you working for your money, and you're not trading time for money, right? So most of the time we have to look at it and understand that life is going to life, whether you like it or not. There are always unexpected things that are going to happen, right? So it's imperative that we plan for that accordingly. Right. And, it's so sad that the statistics now are telling us that 4 in 10 adults don't have the proper means to cover only a $400 emergency. And sometimes this is also true in businesses. Sometimes you have the government contracts that you're working on paper. It says 30 days is when you're supposed to get a payment. What happens if it goes to 45 days or it goes to 60 days or it goes to 90 days? Or you still have to be able to make and meet payroll within all that time. So it's imperative that we understand that we have to figure out how to plan and don't get caught up in failing to plan, right? And also something else is that, most people don't plan to fail. They just fail to plan. And it's imperative that we plan for everything. There are people who are going to spend, and this is the sad reality, there are individuals who will spend 6 months to a year planning for a wedding, but will not sit down for an hour or 2 hours to be able to plan for their financial future as well as for their business financial future. Sometimes you have the business owners who get caught up in saying, I have to be able to run the business. So instead of taking care of the business, they're in the business. So it's imperative that we understand that we gotta do things that are proactive towards our business, right? And sometimes maybe the reasons why we don't have enough saved for retirement is, you know, like I said, we get consumed by emergencies that get to a point where you're not able to plan accordingly. That is normal, and those are some of the journeys that we take as business owners. And one of the things that also comes up is that it's through I don't like to say the word failing, but through the challenges that we go through, that's how we learn. And if we take it as a learning experience, then it flows to give us better and better experience the next time around, right? So let's touch on the emergency fund here, right? Everything that we do is preparing us to move forward with our businesses. But sometimes emergencies happen, and also on a personal level. You know, you may have your work truck, you know, your driver goes out and they call you and they say, oh, the system is down, the car is broken down, it cannot work. Or maybe it's in, you know, in a business where you do production and one of the machines is not working. Yes, there are protocols that go with getting the repairs done, but sometimes we don't plan not only financially, but also business-wise to take care of some of those repairs that happen, right? So it's important to have an extra source of funds and save for the rainy day, because that not only gives you peace of mind during a stressful time, but it also makes sure there's continuity of business, right? And sometimes it could be due to serious illness or hospitalization. You could have a big project coming up and you have two of your best team members who are going to be doing that job for you. And God forbid, you know, right now we have a upper respiratory infection going around, and your two key components of that business project are down. What would you know, how would you be able to handle that emergency? Yes, you have people who are cross-trained, but also, God forbid, if it's you who's the business owner, how much would that emergency cost you? So it's imperative to make sure that you do have the emergency fund in place, right? So a rule of thumb is 3 to 6 months. But of course, after COVID, we looked at it and we moved it from 6 to 12 months. And also from a business perspective, it's imperative to also start saving up from your profit to set aside some money so that this little investment, or kitty as we call it, is going to help you go to the next level if anything was to ever happen. Okay. So step one, we start by setting up realistic goals. So start saving. Let's say now, for example, if it's a new business, you can look at start saving $1,000. If it is on an individual level, you can also start saving $1,000. And as the business grows, you can start moving that figure as you move ahead, and you make it a goal that keeps shifting. And that way you're also motivated to move to the next level, right? And then, like we mentioned, 3 times of the monthly income that you're getting from the business, and you keep increasing it to 6 times the monthly income or the profit that is coming in, or the money that you're generating. So your projections are going in that direction, right? 3 good options to consider for emergency fund are as follows. Making sure that you separate money. Also, it's imperative to ensure that you don't get caught up in commingling funds. So setting up a separate bank account is a good way to do it. Another way is to put it in bonds and mutual funds, or ETFs, which have a relatively low risk, because you don't want to put your money where you're investing it and then you have the threat of, oh my God, I'm going to lose you know, a huge chunk of my portfolio. And last but not least, it's money market funds, right? And always please remember, a credit card is not an emergency fund. So please do not rely on that, right? All righty, so we are going to touch back again on the financial foundation. It's imperative we start from there. You always make sure you have the proper protection. For those people who have partners, it's imperative to start considering ways to make sure that, you know, both the partners or multiple partners are protected. God forbid if anything was to happen to one person or the other, and they become incapacitated, or God forbid they pass away. You got to make sure that you protect the business, and you have what we call buy and sell agreements, which make sure that there are funds that are set aside to make sure that if somebody is not available, one of the business partners is not available, then you have the option to buy out their shares so the business can continue going. Another thing we also need to look at is to make sure that you are also getting paid. So using this tool, proper protection, can also make sure that you set aside some funds to pay yourself. We have the general rule of thumb that says for those people who are salaried, calculate it to the point whereby the first 1 hour you work, you have to have the discipline to pay yourself first. For the first 1 hour your business makes, make sure you have the discipline to pay the business first. So those are some of the steps that we encourage most people to do. You go back again to debt management. This is to make sure that as you go forward, if you're able to get different accounts that are able to give you credit for your business products and services, it's imperative to work with those and seek out those ones rather than the ones who have, make your payment before you get your goods, right? And again, we go back again and we touch on the emergency fund. It's imperative to always make sure you're setting something aside to help you grow. And last but not least, we're looking at investment. We have to make sure we're putting the money where the money works for you, right? So growing your wealth and making more money is something that is imperative to every part of the business, right? So we ask, most of the times we go out and we ask people, why do we invest, right? We work so hard all our lives hoping that we become financially independent, right? And we build up wealth in hopes, to purchase a new home, to expand the business, to retire sooner, provide better opportunities for our children or family members, or also to grow, with our employees, right? And also to control our time, right? So the idea is to make sure that we are investing with a purpose where we get your goals together and we get together and work on a strategy that will take you in the right direction. So one of the things that we also share about is the cycle of building wealth. We can look at it as 3 simple steps or 3 phases. The first phase is accumulation stage, sometimes also collaborated or with the contribution stage. So we are looking at once you have the money, where are you going to put it so that it can accumulate? You have to understand what vehicles are best have your best interests to make sure that your money grows, right? The second stage is distribution. Once you get to a point whereby you have completed your goals for your business, and maybe you're at the point where you're ready to retire and now you need this money now to start working for you, how are you going to get it? Once you receive it, what are the tax implications of the way you accumulated your money towards your distribution? How much of it are you going to get back? And last but not least is the estate transfer, right? You got to make sure that when you get the funds, that when your time comes and you're no longer here, once you're getting ready to transfer your estate and transfer your legacy, that it is not going to be a hindrance to the people that you're leaving it to. Are you going to leave it to the government to make the decisions for you via probate? Or are you going to make the decisions of where you want to have your money go and how you want it to help your future generations, right? The good news is people are living longer, right? Back in the day, life expectancy was age 65, but now for men, it's gone between 85 to 90, and for women, it's from 90 to 95. So we are looking at the statistics growing. The numbers we have here are from 2019. So MIT did a survey and they realized that the life expectancy is increasing and women tend to live longer. We haven't figured out the secret yet, men, but maybe one of these days we'll share it with you, right? The bad news is that most people are not saving enough for their retirement. Only 36% of non-retired adults think their retirement savings are on track. And that's a very, very dismal number that we're looking at there. So from here on, I'm going to go ahead and hand it over to Philip to take it on. Thank you very much for listening to me. And go ahead, take it away, Philip.
Thank you, Miss Pauline. Thank you very much.
Let me stop
That was
sharing my screen.
awesome. All right, let me go ahead and bring up my screen in a moment. I guess this one. Okay, can everyone see my screen? Miss P, you can see my screen? Miss Pauline, can you see my screen?
Yes, we can.
Okay,
Oh, no,
awesome.
not yet. Not yet.
Not yet?
No.
Still no?
We can see your screen.
Oh,
Okay,
okay.
thank you very much. So let me move from here. So we see today that there is a shift in responsibility. In the previous years, a lot of people used to rely on Social Security. And as the shift continues to happen, most companies are not doing anything when it comes to pension like they used to do before, right? We see the three-legged stool, which is personal savings, company pensions, and Social Security. The amount of people today that are contributing into Social Security fund continues to dwindle down. Most people are not having as many kids as they used to. A lot of people have made the decision not to even have kids. So that impacts how many people are contributing into Social Security fund. So we may not be able to rely on Social Security for retirement. And if, our company pension is almost something of the past and personal savings, people are not saving enough, where does that leave us? For your own situation as a business owner, what would you depend on for retirement from most to least? If you don't actively take the time to make sure that you start investing for the future, right? And also, a lot of people tend to procrastinate things that we're supposed to do, maybe today we say, oh, we'll do it next week or we'll do it next month. And before we realize it, it takes a lot of time and we lose so much time. The real question we want to ask ourselves is, can we really afford to wait? So if we need $1 million starting at age 65, as a business owner, say you started early, we want to see how much you need to put every single month. If you were saving, in an account that gives you 8% return, at age 25, you need to save just $286 a month, right? By the time you wait 10 years, at age 35, now you need to save over $666. And if you continue to wait at age 45, it goes up to over $1,600. At age 55, it goes up to over $5,429. So what does this tell us? The longer we wait, the more challenging it, becomes for us to save. And the higher the amount that we need to save, regardless of whether you have time. The truth is you can always leverage the market, right? And since we didn't cover all the ages in this, if you want to know, how much time you have, how, old you are, what you need to save, you can scan the barcode and then you put your age, determine what goal you want for yourself. What is $1 million, 2 million, 5 million? By the time you get to retire, it will tell you exactly how much you need to save at what interest rate. One thing we get to see is a lot of people nowadays, even business owners, we save most of our money at the bank. And when you think of it, the bank doesn't really give us any good interest. So I wanted to talk about how money grows using the rule of 72. This was discovered by Albert Einstein. He found out that if you take 72, you divide it by the rate of return or interest, it will tell you approximately how long it will take for your money to double. So in this first example, we see that if you put your money in a place where you earn 6% interest, We divide 72 by 6, your money will double every 12 years. So if you started with $10,000 savings today, in the next 36 years, that thing will compound to over $81,000. But if you were saving in another bucket that you earn 8% interest, the money doubles every 9 years. In the same amount of time, you're looking at over $159,000. But if you had it in a bucket that you earn 10%, your money doubles every 7.2 years. Same amount of time, we're looking at over $309,000. What does this tell you? Assuming that you were saving in the bank and the bank gives you less than 1% interest, but let's assume that the bank gives you, 1%. Applying the same rule of 72, it means your $10,000 will take 72 years before it becomes $20,000. As a business owner, do you have 72 years to wait for your money to grow so you can leverage it to scale your business up? Most people, we don't have that kind of time, whether it's from a business perspective or a personal perspective. So this is why it's important for us to understand, right? For most business owners, since we're not, employed by anyone, we have to be responsible for saving for our retirement. The question now becomes, where do we save for retirement? What do we know? What do we have? How much do we know about it? Right? Even on a personal level. For most of us, since our company may provide 401k, 403b, 457, depending on the kind of employers we have, majority of us, all we know is, hey, sign here and you're part of a benefit plan. But some of us, we have never taken time to even check and see what is there, what is the performance, what has been the average return over the years. And most people who don't check, I always ask the question, how do you want to retire on something that you don't even know what's there? Right? As a business owner, how can you properly start saving to ensure that you can have, a good retirement for yourself? Because most people, they don't even save. All their money is tied into their business. So if the business goes bankrupt, they fail on two sides, both from the business and the, personal level. So our goal is to make sure people understand this and show them strategies on how they can be saving through the business in leveraging different plans that we show them to minimize their overall tax liability and still ensure that they have a good retirement for themselves. So let's talk about financial market. The question is, so where can we invest? We want to understand some of the terms that you've probably heard before. We'll start first with equity market, otherwise known as the stock market, which is simply a financial market where we have shares of companies that are issued and then traded, whether it's through an exchange. Take, for example, Robinhood, TD Ameritrade. Now they've been bought over by Charles Schwab, or there's so many different exchanges that you can buy and sell on, right? So equity market is simply known as a stock market. Then now let's talk about mutual funds. Mutual fund is usually a professional managed fund. So they'll have a money manager or fund manager who has experience. How does it work? Mutual fund, it allows a pool of money. So let's take, for example, you wanted to buy a share of Berkshire Hathaway. That share is very expensive. Just by yourself, you may not be able to buy a piece of it. But now you being part of that mutual fund where you have that pool of money from various people, you can own a small percentage of Berkshire Hathaway or maybe a Tesla or Amazon share, right? So other investors, you get to pool your money and purchase, different stocks that will be part of your portfolio, or whether it's bonds or securities that it could potentially be very difficult for you to buy by yourself. And then ETFs, otherwise known as exchange traded fund. This simply refers to a type of financial asset. It gets to track an index. It can track a sector, maybe like what sector? Like maybe say travel. No, not really travel. Say let me think of a sector like healthcare sector. Then also commodity. It can track maybe a thing like corn, soybeans, and so on, right? Or other assets. It can be purchased or sold on a stock exchange, the same as a regular stock. Now, let's talk about strategies over strength. What do we invest in? The truth is, most of us, we get bombarded, through social media. We look the news, the internet, where, we get all kinds of things. The question now is, where do we invest? For most people, we are chasing after the next best thing. Is it stocks? We jump into it. We have no understanding. We have no know-how of how to do research of a company, how to read charts. Because a friend tells us, hey, this is what I'm doing, we just jump and do it. And we hear real estate is the it thing now, we jump into it, precious metals, crypto. Remember back in COVID, during COVID period, a lot of people jump into the crypto market, uh, jumping on Dogecoin, all kinds of different coins. Most people end up losing their money. And I always ask a question, what is the first three letters of crypto? It's cry. So a lot of people were left crying, right? Is it gas? So a lot of times, some things might seem very hot at the moment, but usually what might be sensational today may not be tomorrow. You want to take time to educate yourself. Don't just follow everybody and jump into trends. Ensure you understand your financial foundation and follow it. Know what your risk tolerance is. Understand your personal situation because you need to know before you invest. Don't just follow people who may not, they may have completely different risk tolerance, from you. Learn the strategies that work for you and stick to it and make adjustments over time as you continue to learn. So now let's look what we previously looked at were just averages over time, right? Let's look at what happened over the past 50 years. So when you look at this chart, you see there's been ups, there have been downs. The market doesn't fail. It will go up, it will go down, right? But most of us, we've been taught that buy low, sell high. The question is, when is the low moment? For a lot of people, they say, oh, the market has gone down, and they jump to buy. The market even goes further down, and then you're left holding the back. Most people want that quick return, and they take capital that they could have, maybe use it to expand the business. They say they want to multiply it in the stock market. They end up not just losing only that capital, they end up losing way more than that. And a lot of people end up in bankruptcy because a friend said this is a sure bet, right? So you should understand history. Don't get swept by that sensational headlines, that the news make you feel like, oh, this is what you must do. Understand your, risk tolerance, understand, and also make sure that wherever you're investing, will you be able to handle the loss? Understand the portfolios that you put money. So let's look at this. If you can truly handle the losses, we want to look at potential portfolio investment loss and how much you need to get back to even, right? So as a business owner, if you choose to invest in a place and then you end up losing 10%, assuming you invested $10,000, if you lost 10%, you need 11% to get back even. Most people think that they'll need the same 10%, but that's not true. If you had $10,000, you lost 10%, you go down to 9,000. If you gain 10%, you'll be just back at $9,900, not 10,000. So you need 11%. What if you lost 20%? Now you need 25%. And guess what? If you lost 50%, you need 100% to break even. If you lose 60%, the dynamics completely changes. Now you need 150%. For most people, think back. Remember the dot-com crash in 2000 and also the one in 2008 and also during COVID. We experienced a huge, market crash too. So if you're investing in a portfolio where you don't have safety as part of the strategy, if you lose 50%, do you think you'll be able to recoup 100% to break even before you start being profitable? Know where you invest, right? And let's talk about dollar cost averaging. I want us to change gear a little bit and talk about, potential strategies that will help minimize those losses. When it comes to dollar cost averaging, it is simply an investment strategy in which you as an investor, you get to divide up the total amount that you invest across periodic purchases. The goal for this is to help reduce the impact of market volatility on the overall purchases that you make. So assuming that you start with $900 one-time lump sum, right? Versus if you split it across 9 different purchases with $100, right? Let's look at how this works. We have Alex's mom loves him so much, she chooses to save $500 for him over the next 5 months. She leverages the dollar cost averaging strategy. In the first month, the share price is $20. She's able to purchase 5 shares. In the next month, the price drops to $10. She's able to purchase 10 shares. Excuse me. And it drops in the third month to $5. She's able to purchase 20. It goes down to $2. She's able to purchase 50 shares. Now, it goes back up to $10 in month five. Totally, she has 95 shares now. So let's look at the result of dollar cost averaging. Now that she has 95 units, if the price is $10 and she chooses to sell it at $10, she'll make over $950. So that is profit of about $450. But if she decided that, hey, I wanted to use this $500 one time, lump sum to buy the shares at the cost of 20, then she will make just $250. So she would have incurred a $250 loss. So dollar cost averaging is a great strategy to ensure that you're able to work, accordingly how the market moves. You end up strategically owning lots of units of shares. So it goes a long way. Now, diversification. Most of us, when growing up, we've heard about don't put all your eggs in one basket, which is a great strategy. Diversification is a key strategy to manage risk and also market volatility. It helps you to ensure that you allocate investments across many financial instruments or industries or categories. So let's look at these examples. If you're investing in just company one versus, three other companies, or just one industry versus three different industry, right? So diversification can be used when thinking about how you will incur taxes, for retirement. Wherever you're contributing your money, is it taxed now? Will you continue to pay taxes today and for the rest of your life, or is it taxed later? Think of it. If you have money mostly in retirement plans like 401k, 403b, 457, TSP, IRA, annuity pension, those accounts you don't get to pay taxes today, but you get to pay taxes down the road. So if taxes go up, it means you will be exposed to a huge tax liability down the road. And for most of those accounts, if you make early withdrawal, you get hit with a 10% penalty if you withdraw before 59 and a half. And at 72, they also have what we call required minimum distribution, otherwise known as RMD, where IRS tells you you must pull a certain amount of money from your account. And if you don't follow with the instructions, they hit you with a 50% penalty. So we want to make sure that we understand the implications of tax now, tax later, and tax advantage account. Tax advantage account, it helps you ensure that whatever you've invested, as it grows, you get to keep it all for yourself. You never have to worry about taxes. Also, make sure you understand your goals, short-term goals, mid-term and long-term goals. For the business, what are your goals? And are you saving accordingly? Are you balancing across those different goals that you have and the different buckets that you can put your money in so you can be able to properly manage taxes and also manage market volatility? Let's talk about rebalancing. So, assets in the portfolio will usually gain or lose value over time, whether we like it or not, right? So, the percentage it makes of the total portfolio will shift. Rebalancing is necessary to ensure that you bring back your portfolio to its intended asset allocation. So, say you have asset one, 25%. Over time, your portfolio shifts. You can change it to 30%. You can rebalance it back to 25% to help you attain the goal that you wanted for yourself. And when it comes to investing, whether it's for business or for personal, you must make sure that periodically you reevaluate what your investment goals are and also your risk tolerance. When you're younger, you may be, very open to risk. But as you grow older, you don't have the amount of time that you used to. And if you're nearing retirement, you don't want to be putting your money where you have the potential of losing it. You must understand your risk tolerance and then invest accordingly. So, when it comes to risk, you must be able to understand where you stand. So, we have a suitability questionnaire that it will help you provide a simple assessment, right? It will help you determine the type of investor that you are so that you'll be able to select a proper mix of investments consistent with your financial situation and also your risk tolerance. So I encourage you, you can scan this, you'll get the questionnaire, and through the questionnaire, you'll be able to determine what kind of investor are you. Are you very open to risk or are you not? Are you a very conservative person or you are not? So, understanding your risk tolerance. As life changes, your objectives also change. Maybe when you were 25, you didn't really care. You say, hey, if I lose it all, I'll still get it back. But when you're nearing 65, you can't really say the same, right? When you're younger, you may be more aggressive. As you grow older, you may want less risk. So, looking at this, if someone is very conservative, they may have just 10% in equities, 90% in fixed income because they want a fixed rate of return. They don't want to play too much. So even if they lose 10%, they are not too worried. For those who may be a little bit younger, they may have a moderate conservative risk where they allocate about 70% into fixed income, 30% into equities, right? And for those who are moderate, they may have a 50-50 split. And for those who are moderately aggressive, they may have 70 into equities, 30% into fixed income. And for very aggressive, about 90% into equities and just 10% into fixed income. I've had clients who when your 401k was set up, they didn't even know what kind of, investment allocations that was part of their 401k portfolio. So they are 55, almost 60. They still have very aggressive strategy. And when the market went sideways, some of them lost over 30% of their portfolio. So when I met them, I reviewed, I said, man, you're nearing retirement. How can your portfolio still be, almost 90% into equities? What if the market goes down 40% or 50? Will you be able to retire comfortably? And as a business owner, you want to make sure, because if you lose capital, it may be very challenging for you to be able to access capital. So ensure that you understand your risk tolerance and act accordingly, right? So what works for you? When we look at diversification meeting risk tolerance, asset allocation is the key. It helps you understand, and build your portfolio accordingly. Understand what your goals are, what your risk tolerance is, how long do you have to invest. For someone who is maybe in their 30s, they may have another 30, 35 years to plan for retirement. For someone who's at 50, they may have just maybe 15 years if they choose to retire at 65. But today, retirement has been pushed to age 67. But whether it's pushed to 70 or whatever, retirement has nothing to do with age. It has everything to do with the money you have saved up. So if you have enough today, you can choose to retire. It's always essential to sit with a financial professional who can work with you and help determine which allocations will be best suited for your needs because every individual is unique, right? So, knowledge to move ahead. Questions that you can ask yourself. How can I improve on what I have? Because you may already be doing certain things which is helping you, but are there ways to optimize what you currently have? And what strategies am I currently implementing that will help me achieve my goals? Is your goal to be able to ensure that you have good enough emergency fund? Say if market conditions changes, you are still able to make payroll. You're still able to pay, the other people that you're supposed to pay, right? And how tolerant am I to risk? You must know your risk tolerance. I cannot overstress this. So knowledge is very powerful. But what is truly powerful is you becoming an educated investor, whether it's for your business or for your personal. Once you're educated, you can make better informed financial decisions. Don't let this to chance, right? So only you can take the steps necessary for your future. And one of the greatest miracles is that you can truly change your life simply by changing the way you think. And as part of our program, we not just hope that this information will be impactful to you, we hope that you take the information and be able to make strategic changes when it comes to building your financial future. On that note, I want to thank you all very much for giving us the opportunity today to share. I'll pass it over to you, host. Thank you so much. And if you have any questions, I'll be very happy to take them. Thank you.
Thank you so much, Philip. Let us look in the chat and see if there are any questions. Let's see, I'm not seeing any. Janae, do you see any questions?
I don't.
AI meeting notes. Okay. Okay. Okay, so we're not seeing any questions in the chat as of yet. I just want to give the audience just a few minutes. Please put any questions you may have in the chat. Okay, September Blue says, Philip, how can I reach out to you to discuss my business investment and retirement goals?
All right, thank you for the question. Um, let me just can I write in the chat? I can put my number and
Yes, you can put your
email.
information in the chat, Philip.
Okay.
September Blue, Philip will put his contact information in the chat for you. We will be emailing out a survey today, along with the information from the presentation today to all of those who have attended.
Okay. Ms. Pauline, you want to put your information?
One other question, Philip, September Blue says, also, how do business owners vet financial advisors, estate planners, and lawyers?
I think when you get to speak with a financial advisor, ask them if you can reach out to some of your previous clients, right? So they can provide you a list of your previous clients, whether it's business owners or personal clients, who are not business owners. So you can talk to them, ask them real questions, so they'll be able to tell you, hey, this is how this person works, or they'll be able to tell you the truth and really ask good questions. And then once you're working with someone, make sure the person is not pressuring you to get into something, right? Make sure that they take the time to educate you on the pros and cons of any strategy, because every financial strategy we have its benefit and it will have areas that, there are shortcomings. So you need to be able to properly understand that. If the person doesn't take time to educate you, that's also a red flag. And if you ask questions, they keep waving the question away like you are ignorant, that's also a red flag. And make sure it's someone that you can reach, right? Not someone that will just set up something and then disappear. You have to have someone that stays on top of it, keep you updated, whether it's quarterly, you know, um, biannually, or have annual reviews with them. So those are very important things. But first, start with if they can refer some of your clients for you to call and validate, then make sure they educate you, right? Before you get into anything, they don't pressure you. So those are some ways that I'll do and research the company.
Thank you so much, Philip.
Thank you.
So I don't see any more questions right now. And if they do put some questions, we'll make sure to forward them to you, Philip and Pauline, okay?
Okay. Thank you so much.
No, really, thank you. Every time you guys come, it's like, oh, it's like, yay! The audience is really responsive and they want you guys back, So I just want to say thank you so much for coming. I want to say thank you to our Deputy Vice President, Tamira Roberts. I want to say thank you to my team behind the scenes. Oh my God, you guys are always awesome. Michael, thank you so much. Shanae, thank you. I hope everyone was able to learn some important information to help their business grow. It's so important now to just, get as much information as possible. I always say the temperature outside is changing when it comes to small businesses and the opportunities. It's a lot of information coming out there now for small businesses from the different federal agencies. So I know it's a lot to take in. What we try to do is simplify some things for you if we can hear. The surveys are important. It lets us know that you want presentations like Philip and Pauline's to be continuous to help your business. Remember, certification here is the key to participation, and we do look forward to your applications coming in. And we hope you have a great rest of your day. We also look forward to you making sure we see you at the rest of our outreaches that we have coming up in September and October. Please visit our website, and everybody have a great rest of your day. Thank you.
Thank you. All right. Bye-bye.